There we go. Um, I think as depending on who you follow online and what you're watching on the news, a lot of us have just gotten completely bombarded with interest rates dropping and is it time to refinance? And we get pummeled with different stuff in the news. And it's a lot of moving pieces, and we want to just be able to make sense of it and what makes sense for our ideal scenario, especially for those of you who have purchased in just the last few years. That's what this is really geared for. Um, In the last couple of weeks, we've seen economic data, a lot of it come out. A lot of it was anticipated, and we were hoping to see what happened happen, right? We've all been expecting interest rates to come down for a few years, but it's really that why behind it. And so I want to take a second and acknowledge it's great if you're in the mortgage world and interest rates have come down a little bit. But on the flip side of this, that's usually bad news for our economy, right? Dow is down, markets are down. If you are brave enough to go look at your 401k account, it is probably significantly lower than where it was 3 weeks ago. The reason we're having this response in interest rates is largely because of economic data softening, and unemployment numbers came out higher than where we anticipated them to be. What's interesting is that if you don't know, mortgage interest rates do not move directly with Fed fund rate. So when you watch the news and the Fed says they're going to have 4 rate cuts before the end of the year, that does not necessarily mean that interest rates are going to come down 4 separate times before the end of the year, at least not for your average 30-year fixed mortgage. On a credit card, on a car loan, on short-term loans, the Fed fund rate does directly impact those things. Mortgage-backed securities are more so what push through and dictate what's happening with interest rates. Countries, big establishments all over the world invest into mortgage-backed securities. And mortgage-backed securities historically have been supposed to be a safe bet and something people want to put their money into because we know what's going to happen with it. And in the last few years, based off of what the Fed has done and what our economy is doing, we've had a lot of pullback from mortgage-backed securities. So we haven't had the liquidity in them, which is pushing interest rates to be higher. The improvement we saw over the last few weeks in interest rates is largely because the Fed has now said, they haven't said, there's 100% likely chance that they're going to cut interest rates in September for the Fed fund rate and additional cuts through the remainder of the year. Mortgage-backed securities like this information. This is what they wanted to see happen. They feel that the unemployment numbers were there. We've all seen the inflation ticking up. People know people are struggling on a month-to-month basis. So now that the Fed is responding, hopefully the way they want them to be responding, people want to put more money into mortgage-backed securities, which calm down our interest rates and put them back to a level where they really should have been at the whole entire time. What's interesting in this is you'll see right here at the end of the chart, we see this dip down, and then all of a sudden we see kind of come back up. In the next 6 months, 9 months, a year, as we see interest rates trend down, we're going to get these probably like valleys, and then the market's going to settle back up, and then it'll kind of plateau again. When we were going through COVID, which was very unprecedented times, we saw interest rates plummet, continue to plummet, and then stay plummeted for months and months and months and months. People could take advantage of refinancing at 3%. It didn't matter if they didn't call their loan officer back for 3 weeks. Interest rates were still 3% a month later. That is likely not the market we're going to be in this refinance time. And so my goal is to have you really educated on when is the best time to refinance for you, why would you refinance, what to watch out for, and just kind of any other general market knowledge that you just maybe find interesting. If you do have any questions, feel free to take yourself off mute or just pop them in the chat. Oh, hi, Kelly. I hope you're having a good walk with the dog. I'm glad you're hopping on. There are no bad questions in this. I think there's so many misconceptions and so much misinformation all over the internet. I would be shocked if you all are not thinking the same questions as I go through it. So feel free to interrupt at any point in time. As I mentioned, we are expecting Fed to cut interest rates in September. Again, this does not mean it's a direct correlation for interest rates to drop. Mortgage-backed securities and countries and large establishments that invest millions and millions of dollars in mortgage-backed securities, they're not going to be caught on their heels. They're not waiting until September to go, Oh, they really did cut the rates. Okay, now I'm going to respond with my interest rates being lower or with putting more money in mortgage-backed securities. They're already trying to predict where interest rates are going. So right now, everyone feels that 6.625 is kind of that settled interest rate where we're seeing the best premium pricing in interest rates because investors want their interest rates there because they think that's where it's going to kind of level out. And if you have a 6.625 interest rate right now versus a 7.5% interest rate, you're likely to stay in that mortgage for longer. These servicers and these investors, they don't make money from only having your loan for 90 days or 6 months and then you going to refinance. In fact, they lose money that way. Their ideal is that you pay a little bit of points when you purchase your mortgage, or you get into an interest rate where you're going to be happy and kind of in that exact loan for at least a year or hopefully longer. With all of these rate projections, a lot of these were projections that were anticipated to happen like I don't know. I feel like it, Marty, I feel like it was like 2 years ago when we all sat on calls on Mondays. We'd be like, this May, this is the time when rates are going to drop right here.
Right.
Um, and so mortgage companies have been gearing up and staffing for this movement we've seen for years. So now they've had people on their books, staff members, cold callers, call center employees sitting there waiting for these interest rates to drop. And now we saw a little bit of improvement, and they're all going to jump on the opportunity and try and have different conversations, even though it might not be the best time to refinance. Let's start with all of the different reasons you would refinance. The most obvious one we think of is lowering our interest rate, which hopefully gives us a lower monthly payment. Other things besides that, cash out. When we're talking about people being laid off, we're talking about inflation numbers being up. We're talking about 401ks plummeting. None of these are happy go lucky things to talk about, and they're not great things in our economy. When you go to the grocery store right now, a container of organic strawberries at Lund's literally cost over $8. If two of your strawberries are bad, which they always are, at least like two are moldy, that means you spent 85 cents per strawberry. That's insane, right? Like we've all felt the pinch of inflation and prices going up and all of that. So for a lot of people, as we're talking about interest rates coming down and refinancing, they're instantly blocking it out because they're like, I can't refinance. I can't even afford to refinance. But some haven't even taken the time to consider, okay, the reason I bought my house was to build equity. My home has appreciated in value. Maybe I'm sitting on some equity that I can tap into with a cash out refinance, a HELOC, a second mortgage, whatever the case is, and I can pay off all my credit card debt and I can kind of get a fresh start because interest rates on a conforming or fixed or HELOC are still less than the average interest rate of a credit card, which is at 25%. So refinancing is not just about lowering your interest rate. It could be a lot of different things. Mortgage insurance, which is MI, if anyone doesn't know that. So when you purchased your home, you maybe did 3% down, 5% down, and you purchased 2 years ago. Well, now, if you've seen your neighbor's house is all of a sudden selling for way more and your home is very similar, it might be a good time to look at your value. And not only could we lower your interest rate, but we could also get rid of your mortgage insurance. On your monthly mortgage statement, you should be able to see a line item for it on there, and it'll say disbursement of PMI. That's your mortgage insurance. That's how much you're paying every single month. Sometimes, even if we can't get it fully removed, we can get the premium much lower. So we could do that in conjunction with lowering your interest rate to save you money monthly. Paying off debt, we kind of talked about. A first and a second. A lot of people purchase their home with down payment assistance products. They have like second loans on their house. Maybe you've already taken off a HELOC. Maybe you've taken a second mortgage for renovation. A refinance is a really good time to consolidate those debts into one loan. So you've got one fixed monthly payment. Typically, second mortgages can carry higher interest, or they're an interest only loan and you're not even paying down the balance of that loan right now. Combining it into one will help you build equity faster. We've had some clients who have gotten divorced over the last 2 years, and with interest rates, they haven't even been able to afford to take the ex-spouse or whoever it is off the mortgage. Taking a cosigner off or a borrower who's not in the home anymore is another reason you might refinance. And then lowering your monthly payment. And of course, you can always change your loan term. Maybe you got into your mortgage and you were at a 30-year fixed, and now you really want to be on a 15-year or a 20-year. That's an option as well. I'm gonna be totally honest. I did not even know that mortgage churning was a real thing until I saw people posting about it on all over Facebook and Instagram. And I mean, I knew the concept of it was bad, but I didn't know it was a real thing that was actually legal. And I'm glad that it is. Here it is. So mortgage churning means what is essentially happening right now, where people are getting bombarded by call centers that know you currently have a mortgage of over 7%, and they are calling you trying to shave off a 1/4% of your interest rate. And then they'll call you again in 6 months to shave off another 1/4% of your interest rate. And they just do this over and over. They reset you on a 30-year amortization schedule. They charge you points and fees, all of these things that just get added to your loan amount. And then you're never really building up equity in your home because you're continually adding closing costs, monthly payments, new escrow balances, points, all of that to the balance of your loan. Mortgage churning is what we want to avoid. When I talk about these people and these companies who hired hundreds of call center employees and all of this to get ahead of the refinance boom, these people have been sitting on their hands waiting to see interest rates drop a 0.5%. I have clients who are sending me literature from their current mortgage servicer where they can't even save them actually on their interest rate. Their marketing tactic is just, but you'll get to skip a monthly payment. You're not even really skipping a monthly payment because mortgages are paid in arrears. So you're just kicking that payment down the road. Yes, you could just skip a monthly payment, but no one's like covering your mortgage for free for a month. So that is what we're trying to avoid. And my goal in this today is hopefully when I educate you a little bit more, you'll be able to hear and pick up on, this is what this person is showing me. This makes sense. This is what I was supposed to avoid, or this makes perfect sense and it's a good deal. Here's an example I pulled from Wells Fargo's website. This is on a conforming refinance quote. The client was told that they're not paying any lender fees. So, a very common marketing thing that every company has done, we're doing it as well. None of my past clients will pay lender fees when they come to refinance with us. That being said, these mortgage companies are not disclosing that discount points are still being paid. Discount points go hand in hand with the interest rate and are different than lender fees. So it's very easy for them to say, "Oh yeah, there's no cost of this. I'm waiving my lender fees too," but you're still paying money to get to that same interest rate. So on this example, they're pulling a $200,000 loan. They're quoting an interest rate of 6%, but they're charging $7,800 to get to that lower interest rate. For quick math, I did it right before we hopped on here. Let's say this person was at a 7% interest rate. So we're able to lower their interest rate by 1 full percentage point. Now we're down to 6%. This seems like great savings, makes perfect sense. You save $140 a month. That's a lot for someone who has a $200,000 mortgage. But with the $7,800 in closing costs, it takes you 56 months to break even on that, or over 4.5 years. In the next 4.5 years, I believe that we will see interest rates lower than 6%. And if you refinance to 6%, and it takes you 4.5 years to even break even on it, and now interest rates go to 5.5%. What if you want to refinance again? All you're doing is adding money to your mortgage, and then you're never getting a better equity position or building wealth for yourself long term. Here is another one with Quicken Mortgage. This one's even worse. This, they're quoting it with 2 discount points. So it would be double the break even. So on one of these refinances they're marketing, it would take 8-9 years before you'd even break even, where it would make sense that you've even done the refinance. Again, why would someone do this? Mortgage companies are not the most profitable right now. If you look it up on the news, there's mortgage companies that have gone out of business, that have sold, that have closed their doors over the weekend, left and right. Anything they can do to bring a loan in and make a little bit of extra cash, they're absolutely going to try and do. So my general recommendation right now is if we can't break even on your refinance within 12 to 15 months, I do not recommend moving ahead. Meaning, when we look at what your total monthly savings is compared to any cost you're paying, even if you're not paying it out of pocket, even if you're just paying it and it's being added to your loan amount, we want to break even on that payment within 12 to 15 months, or I think we should wait until interest rates come a little bit lower before we move forward on refinancing you. One other big thing that is awesome about Guild that I in full honest transparency, did not even know was a thing until I came to Guild Mortgage, is we service about, I don't know, it's over 90% of our conventional loans, FHA, VA, things like that, which offers us a really unique opportunity because we don't have to restart your amortization schedule at a 30-year term. When you listen to people talk about refinancing, they oftentimes will say, you really need to time the market to make sure you refinance at the bottom of the market because I don't want you to have to refinance more than once. The reason they're saying that is not just because of the title fees that you have to pay or anything like that. It's also because when you're refinancing, you're starting over on a 30-year mortgage. When you start over on a 30-year mortgage, if you don't know, interest is completely front loaded on a mortgage. So in your amortization over 30 years, you pay way more in interest in the first years. And then at the end, it's mostly principal balance and less interest paid. When we refinance you, if we start that 30-year term over, you're repaying all of that interest for the first few years. So if we don't want to have to keep restarting you over, so people will say we need to time the market to get to the bottom of where interest rates are at for it to make sense to pull forward on a refinance. What's very unique to us is we don't have to restart you on a 30-year term. So for example, at a 7% interest rate on a 450 loan amount, or 7.5% interest rate on a 450 loan amount, the first year you pay $33,000 of interest. Even if we refinance you to 6.5%, you still paid $29,000 of interest. That is a really significant amount of money. Most of us would not feel comfortable with the economy we're in or anything like that, going and pulling the trigger willy-nilly on a $30,000 purchase, right? Our goal is that we don't ever refinance you back to this 30-year term. We really want to start you at 29 years or 28 years or some increment in between. Other companies can do a 25-year mortgage or a 20-year mortgage. The issue with that is a lot of us want a lower monthly payment. If we have to speed up our mortgage terms and consolidate what we're paying in principal over 25 years or 20 years, then that consolidates the term of the mortgage, which makes our payment go up every single month. So even though you'd be refinancing, your payment might not be going down. So a lot of people don't take that option. They just take the 30-year option, and no one has educated them or told them that their interest value is going to start all over at the beginning. This is a really, really key principle in all of this. And when you start doing the math on it, you're like, wow, 30, what if you've been in your loan for 3 years and now we're talking about over $100,000 of interest you've already paid that someone would be starting you over on? One thing I think is key to talk about too, loan officers, there's a bunch on this call. There's going to probably be a bunch that listen to the recording too. Loan officers do not get paid off of what your interest rate is. Whether you work with me or you call the guy at Wells Fargo or you call Quicken Mortgage, I am legally not I cannot get paid on what your interest rate is. I get paid by getting you happily to the closing table. And then I hope that you refer us friends and family because then we get paid if we happily get them to the closing table as well. We do not get paid different amounts based off of loan type or what the margin in a loan was or anything like that. I am absolutely as incentivized as the next person to get you to the closing table with the lowest interest rate possible. So sometimes when you're talking to these different companies or whatever, you get this in your head of like, well, I need to shop around because I need to make sure I'm getting the best deal on this refinance, which I think is great. And you should absolutely get different estimates and quotes and feel 100% confident in who you're working with. But keep in mind, 9 times out of 10, everyone's making the same amount of money on your loan. They're just marketing it to you differently. So the points here, points in the last one, no one in our industry is allowed to be paid a different amount based off of what your interest rate is. And so what you really want to be looking for is someone who's going to work with you and understand your long-term goals and your long-term picture and a true strategy to help you build wealth over the long term so that you're not getting stuck in one of these scenarios where you're like, well, the guy didn't tell me. And now I've been in my mortgage for 5 years. I have no equity because I've refinanced every 7 months because the guy kept telling me to refinance every quarter of a point on my way down. We don't want you to be one of those people. Okay, so what should you expect to pay on a refinance? I would say 9 out of 10 companies at this point are waiving lender fees on a refinance. What are lender fees? Lender fees typically range between, in our market in the Twin Cities, they're between $1,500 and $1,800. I think ours are 16 or 15.95 or something. That's what they're waiving for the lender fees. Other costs associated with the refinance that you want to watch for are about the points. Unless you are just gun ho that you want to pay interest, but you want to pay points for a lower interest rate, if you chat with us, I will not show you discount points. I will, if you ask me if you can pay them, I will tell you I do not think we should pay them on a refinance. I will show you 5 different reasons why. If you still want to pay them, I will absolutely let you choose that option, but I would highly, highly discourage paying it in this market on a refinance. That is the one thing you really, really want to watch for on any of these things. Like I mentioned, a lot of these costs you are not paying out of pocket. They just get added to your loan amount. So when you get a quote via email from someone or literature sent to you in the mail, it'll say lower your monthly payment, $0 cash to close, because you are paying $0 out of pocket. They just added it to your loan amount. So that's what you really, really want to watch for. I pulled just a general title quote. Title is the one thing you do have to pay on a refinance. Again, it costs money to register your new mortgage with the county. The title company, even if you just closed 6 months ago, they still have to do the same amount of work to do your mortgage again. So I just pulled a general title quote. I can pop it in the chat too, but if you go to Watermark Title, which is a local Minnesota company, you can go to any title company, and most of them will allow you to pull a quote online. You don't have to be a lender, you don't have to be a realtor, you can pull a quote, just hit refinance, enter your loan amount, hit calculate, and it'll pull you a quote just like this. I believe this was on a 450 mortgage. So this is a general quote of what it would look like. $2,800 on a 450 loan amount. Not astronomical, not anything crazy. Again, normally we can add this to your loan. Some people will choose to pay it out of pocket if they have the cash on hand. $2,800 over 30 years is going to be the difference of a few dollars a month. So normally people do choose to just add it to their loan amount, but it's totally up to you on your preference there. And then escrow account. Depending on if we currently service your mortgage or not, or if someone else has your loan, we might need to create a new escrow account. This isn't a true fee to refinancing though, because you always pay for your taxes and your insurance, whether you refinance or not. We just have to create a new account sometimes. So depending on what month you close and when your insurance was last paid and where you are at your tax season, will determine how much we have to put in that escrow account. As a reminder, your escrow account is just a holding account for your taxes and your insurance. So every month when you're paying tax and insurance, you're not paying them right to Jake at State Farm or to Hennepin County. You've just been paying them into this holding account, and then the mortgage company is paying those bills when they become due. When you go to refinance, you get the balance of your current escrow account back, but then you create a new escrow account. In this scenario, this is someone's actual mortgage statement they recently sent us. You can see their escrow account balance is $71.45. In this scenario, these clients are choosing to create a new escrow account, and they're going to bring their own balance to escrow on the closing, knowing that they're going to get this money back, so they're not adding it to their loan amount. Sometimes people don't want to do that. Here's the reason why you would maybe not want to. Like we talked about the very expensive organic strawberries at the very beginning, some of us are sitting on a little more credit card debt than we'd like right now. Not enough where we want to pull out a second mortgage on our house, but $7,000 to $10,000 would make a huge difference if we could have that little bit of extra cash. When you do a cash out refinance, the pricing on that interest rate is different than just what we call a rate and term refinance. So one creative way we can get a little bit of money out of your mortgage without having a higher interest rate is by adding this escrow balance from your old loan to your new loan. And then the balance of this escrow account just gets paid back to you outside of closing. So you would literally just get a check in the mail for $71.45.89. So if you were a person who were thinking about refinancing, you look on your mortgage statement next month and you've got $5,000 in escrow, and we have enough equity in your house where we can just add it onto the loan amount when you go to refinance. The difference is $10 a month in the monthly payment. Doesn't feel like a big deal. And that extra money in your pocket right now would save you, and you could pay down a credit card, you could pay off a student loan that's been lingering over your head, a personal line of credit, whatever it might be. That's a really cool option as well. Also, one thing to note on the refinance, when you do close on a refinance, like we said, you get to skip a monthly payment, which is true. So let's say we have clients who just closed on a refinance yesterday. So they're closing in the month of August, just like when you purchase your house. They have no payment for August because we just paid off their previous loan. They have no payment for September. Their first payment on the new mortgage will not be till October. I don't think skipping a payment is a reason to move forward with a refinance in and of itself, but it is really nice to sometimes just get a month break, right? That feels good to everybody. So title fees, escrow account, a lot of questions we get to are just like, okay, how does it work? I don't even what do I have to do to refinance? Refinancing is pretty easy. So oftentimes we'll have most of your information already. We're doing a credit pull to make sure you still qualify for the mortgage that you're in. We still have to look at your credit to make sure everything is solid and that you're up to date on your mortgage. We'll get sometimes we need to refresh pay stubs. Sometimes we don't even need income documents because it all automatically pulls through based off of your credit and all of that information. We send everything to underwriting, just like we did the first time. Underwriter says, yep, this is perfect. They still qualify just fine for this mortgage. And then we schedule closing at the title company. Sometimes you need an appraisal, sometimes you do not. If we're trying to increase and get more of the equity out of your house, or we're trying to get rid of mortgage insurance, we might choose to order an appraisal to take advantage of what's been going on in your market. Other times, if we're not trying to stretch our value at all, we can just get what's called an appraisal waiver, which means underwriting has determined the value of your home is still there. We have no concerns around the value. We don't even need to have an appraisal done. Sometimes I'll get the question of like, oh, well, if I have to have an appraisal done, like, do I have to have the cleaners out? Like, can my kids be here? I have a dog. Yes, this is not like when you go to sell a house or when you went to showings. An appraiser doesn't care if you forgot to put the toaster away that morning before you left for work or anything like that. They're literally just looking, is your house in good condition? Are the rooms I think are here still here? All that kind of good stuff for just a general value. We get all that sent to underwriting. We get you to the closing table. You'll go to title. Typically, you're signing documents for 20, 25 minutes. You get copies of everything you have. You're on your way, and then you make your new payment 2 months later on the lower amount that you're going to be paying. Does anyone have any questions? Nothing? One thing I wanted to touch on too is ARM refinances. We're getting a ton of questions right now on like, well, I could refinance into this ARM and that's a quarter of a point less. And does that make more sense for me right now? It could make more sense if that's what you really want to do. But if we're looking at an ARM option where we're still starting over on a 30-year amortization schedule, and so to save a quarter point, we still have to pay $30,000 more plus in interest in that first year, then that no longer makes sense. If refinancing isn't like the end all be all perfect fit right today, this second, there's nothing wrong with still hopping on a call with us and preparing our credit, getting our application up to date. And we just wait and we watch and we say, okay, when is going to be that right time? As soon as we hit this interest rate is when it makes sense. And if that's 30 days from now or that's 90 days from now, at least we can have everything ready to go. And if we've taken the time to plan in advance, maybe we can get your credit score up a little bit. Maybe you qualify for an even better program. Maybe there's other options we can be playing around with, bigger picture to put you in a better equity position, wealth position, pay off some debt, whatever that might be. Thank you guys for taking the time to hop on. I know that refinancing and market knowledge is definitely no one's most exciting or favorite favorite topic that there ever was. Especially, we don't take it lightly that oftentimes we're having these conversations because of weakening economic data. The reasons we've heard from people recently on why they're not moving forward on a refinance is it's just not a good time. We've racked up too much debt. We don't have the savings right now. So and so just got laid off. Please don't be scared to share that conversation with us and for us to see if we can help. Just because one of you is laid off, maybe we still qualify for a refinance on one person's income. That's still a possibility. Or if we've racked up too much debt, Like I said, maybe we should be tapping into your equity to figure out if we can consolidate some of that debt at a lower interest rate versus paying at a 25% interest rate. None of these things are things to be embarrassed about. These are things a lot of people in the country are going through right now, and we're here to help however we possibly can. And sometimes it's just another person to have a conversation with to go, hey, this is kind of what I'm thinking. Does this make sense long term if this is our plan? Absolutely. That is what I'm here for. We're always happy to hop on a call and just go through things large picture with you. As always, everyone has my cell phone, my email. Please reach out as much as possible. We're always here to help. If you know someone that this video could help them too, please pass it along and share it with them. We'd love to get the word out and keep people educated so that no one falls culprit to the mortgage churning that we'll probably see over the next 6 months to a year. Thanks, guys.
Great job, Al.